Welcome everyone, and thank you for tuning in to hear my trading and market updates. This is Uncle Frank, and I'm not a financial advisor, nor is any of the content to be construed as financial advice. This channel is for entertainment purposes only. Please remember to hit the like button if you enjoyed the presentation, and be sure to subscribe to the channel so you're alerted when I have new information to share. So now let's get into the latest updates. Hey, welcome back everyone. Well, you guys know what happened yesterday. Sell off across the board, right? And you know why. Stocks sink after Powell suggests Fed may not cut rates in March. But Zero Hedge had its own take. Hawkish Fed hammers dovish market, no cuts imminent, removes banking system soundness comment. Remember that. Isn't this ironic? New York Community Bancorp stock plunges 38%, reigniting fears for regional banks. NYCB built up capital after acquiring most of the failed Signature Bank in last year's crisis. Breaking today from Cryptopolitan, Saudi Arabia becomes the newest member of BRICS. And that reminded me that Ripple's been there for 6 years. From February of 2018, Saudi Arabia's central bank signs blockchain deal with Ripple. And then from August of last year, Central Bank of Saudi Arabia teams up with Ripple to transform cross-border settlements. And from last month, Ripple major partner SBI teams up with second largest global company. Ripple's major partner in Japan is joining forces with Saudi Aramco to begin promoting digital assets and startups. Can you guess what I'm talking about? You know, every time I include articles about BRICS in one of my videos, somebody always shows up in the chat to tell me it's no big deal. Well, here's one from Cryptopolitan. BRICS dominance surges with 47% of the world's oil. Where does the U.S. stand? Just saying. Happy February 1st to my listeners. We've got 1 month in. Where do we stand? S&P 500 up 1.6% so far. The Dow up 1.2% for the year. NASDAQ 1%. Russell 2000 down 3.9%. Bitcoin 42,618. That's down 2.5%. Ethereum also down 2.5%. Gold 2055.30. down 0.8% so far. Oil, though, 75.80, up 6.3%. Now, subscribers to this channel know that Kenny Griffin is worried if China invades Taiwan, the U.S. could see a Great Depression. But my subscribers also know that hedge funds have been piling into China at the fastest pace in 5 years. We learned from the Telegraph yesterday that China's economy is about to implode, and we will all feel the aftershocks. And today that theory may have been confirmed. China's economic outlook darkens as debt ratio approaches 300%. Now let's start off our AMC segment with the last 2 tweets from our CEO, January 23rd. So painful. 4 years after COVID, the industry-wide box office is still ludicrously anemic, and AMC stock has slid to 448. Difficult to think about anything other than guiding AMC back in these challenging times. But greatness deserves praise. Sixers, Joel Embiid, 70 points. 70. And then from January 28th, media scoffed at my Embiid tweet, but it's all true. AMC's share price is so frustrating. The 2023 actors and writers strikes have ruined the early 2024 box office. Almost all I think about is rebuilding AMC, but AMC based in Kansas City since 1920. So how about those Chiefs? So Adam, you're blaming the writers and actors strike for the current price of the stock, not the ape, its conversion, or the reverse split we never needed to do. It has nothing to do with the dilution tweet the morning after we had the greatest third quarter in our company's 103-year history. That was interesting timing, Adam. You could have let the stock run up and sold our shares at much higher prices, but I wonder why you didn't, sir. Are you sure it's not the constant dilution ever since? Or to put another way, swapping our stock for debt at record low prices for pennies on the dollar, even though we have over $700 million in liquidity. When was the last time you even mentioned the apes in one of your tweets, Adam? Since you're the silverback, why no more clever, inspiring hashtags like choke on that, today we pounce, or there's gold in them thar hills? No free NFTs to give away? I collected them all. How about you? Do you apes remember this headline? AMC Theaters lost $4.6 billion in 2020 due to COVID-19. But don't worry too much about the boss. The 2023 stock bonuses should be announced soon, and that will certainly cheer him up. Of course, our stock and market cap are down over 90% year over year, but if anyone deserves a bonus, it's a guy that screws his own shareholders with a preferred share and has the balls to name it after them. Or maybe a guy that invests almost $30 million of your money in a bankrupt gold mine to bail out 5 creditors that all were or are short sellers of AMC at one time or another. It's just a theory of mine, but at least you got an NFT, right? That stock is down over 65% year over year, so at least this guy is consistent. Try to remember, the pandemic was the best thing that ever happened to Adam Aron and his family. While our theaters were closed part of the year and Hollywood was starving us for releases, his comp plan doubled, and senior management did pretty good too. But enough about this pathetic pervert thief. Let's get to the content. Now, on January 25th, Moody's Investors Service put out a ratings action on the company's debt, and on the 26th, it issued a credit opinion. Believe it or not, there was some pretty good news in there. You'd never know it because the financial media refuses to publish our good news, and investor relations at AMC refuses to announce any of it. Now, as you go through the report, you can see Moody's different ratings on AMC's different debts, like a B3 rating on the $400 million 12.75% senior secured first lien notes. And you go through them all, and at the end it concludes the outlook is stable. Now, obviously, a C rating carries a higher risk of default than an A or B, but a D rating means the bonds are in default, and we don't have any of those. In the next paragraph, Moody gives its rationale behind its CFR rating. The affirmation of the CAA2 CFR reflects AMC's high pro forma financial leverage, currently around 8.1 total debt to EBITDA, and Moody's expectation that leverage will rise to the 9.5 region over the near term amid a weak movie slate in 2024 associated with the double Hollywood strikes last year. Moody's expects this year's wide releases to be lower, resulting in reduced box office receipts near $8 billion compared to $9 billion last year. You see, I don't think it's going to be as bad as they say, but everyone is entitled to their opinion. In the next paragraph, Moody's points to some of the risks. Moody's also expects AMC to continue producing negative free cash flow, or FCF, and rely on its sizable cash balances to offset operating losses, which we project in H1, the first half of the year 2024. Despite the expectation for negative FCF, the company will likely continue using cash on hand to repurchase its high coupon debt in the open market. So we could expect more of that according to Moody's. Last year, AMC repurchased or exchanged a total of $442.5 million worth of debt, which Moody's deemed distressed exchange defaults. Now, this is where I disagree with Moody's. You know, swapping stock for debt, I mean, we could have let the stock rise and sold it directly, but the company chose to sell at all-time lows, right, and exchange stock for debt. They're calling that a default. I don't see it that way. Hence, the rating continues to reflect Moody's view that further distressed exchanges or a potential balance sheet restructuring could occur over the rating horizon given AMC's untenable debt capital structure. Moody's continues, AMC's CAA2 CFR reflects the company's position as the world's largest movie exhibitor, but also considers the uneven recovery in operating and financial performance, which suffered from pandemic-induced revenue and operating losses in 2020 and 2021 when theaters were closed or not fully operational. That's when Adam's comp plan doubled, by the way. Though Moody expects additional debt repurchases and debt-to-equity conversions this year, which will lower the outstanding debt balance, we also expect EBITDA will decline relative to 2023 due to comparatively lower wide release volumes, leading to higher leverage. Moody's continues by identifying the industry's risks. These are all good things to know. The cinema industry's delayed recovery and structural challenges are also captured in AMC's ratings, which include, number 1, excess screen capacity in North America. Number 2, comparatively lower moviegoer demand as studios release some films online via streaming platforms simultaneously or exclusively, or potentially release them downstream in a shortened theatrical window. Number 3, lower theatrical release volumes relative to historic levels due to short-term production bottlenecks. Number 4, reduced showtimes compared to pre-pandemic periods. And 5, the impact of some cost-conscious consumers reducing their out-of-home entertainment and number of trips to the cinema amid affordable subscription-based video-on-demand VOD movie viewing. Now, for those of you that are still awake, here's some of the good news. Nevertheless, over the longer term, Moody's expects AMC will experience profit improvement, albeit irregular, driven by growing moviegoer attendance, higher revenue per patron, an appealing number of theatrical releases and alternative content, and our view that the big studios will adhere to the 45-day theatrical window for major film releases. Exhibitors like AMC also benefit from favorable ticket prices that on average remain relatively inexpensive compared to the cost of other forms of out-of-home entertainment. In this section, Moody's outlook improves as we move into the second half of the year. The stable outlook reflects Moody's view that AMC will at least maintain its revenue share in North America and continue to experience good moviegoer demand and above-average ticket prices and concessions revenue, higher margin, per patron. The outlook also considers Moody's expectation that the residual effect of the protractor's writers and actors strike will negatively impact revenue and EBITDA growth in H1 2024 as movie productions take time to restart and resume their normal cadence, which will pressure higher leverage metrics. I thought the next paragraph had some good points as well. AMC's SGL3 speculative grade liquidity rating reflects adequate liquidity over the next 12 to 18 months, supported chiefly by sizable unrestricted cash balances, which totaled $730 million as of September 30th, offset by Moody's expectation for continued negative FCF over the coming 12 months. Also, Moody's expects cash burn to moderate somewhat in 2024, which should help maintain cash at high levels, barring usage for M&A, that's when Adam invests in bankrupt gold mines, debt repurchases, shareholder distributions, or other capital outlays. Moody's begins to wrap up their report with factors that could lead to an upgrade or downgrade of their ratings. Ratings could be upgraded if AMC experiences positive growth in box office attendance, stable to improving market share, expanding EBITDA with margins approaching pre-pandemic levels and enhanced liquidity, and exhibits prudent financial policies that translate into an improved credit profile. Prudent financial policies. You see, this is why I'm a shareholder activist. I love the company. I love the stock. But I push back on management because they make bad financial decisions. Okay? It's not prudent to double your comp plan during the pandemic. It's not prudent to invest in bankrupt gold mines when you're $5 billion in debt yourself. Okay? It wasn't prudent to reverse split our stock. It's not prudent to swap stock for debt at all-time lows like we did with APE and like we're doing now with AMC. Was it prudent to spend $25 million on the Nicole Kidman ad campaign as opposed to commercials promoting our A-list program? Okay, that's what a shareholder activist is. We support the company, we support the stock, and we push back on management when they make bad financial decisions, or we try to replace them. Okay, I hope you guys are still with me. This is the last slide on the Moody's report. Ratings could be downgraded if there was, 1, a deterioration of the company's liquidity or an inability to access additional sources of liquidity to cover cash outlays. Number 2, poor execution on reducing or managing operating expenses. Or number 3, Moody's expects total debt to EBITDA will remain 10x, or free cash flow will remain negative on a sustained basis. Ratings could also be downgraded if Moody's expects AMC will pursue a balance sheet restructuring. Now, I hope you guys noticed this is the report where Adam Aron gets all his talking points from. Wall Street. Did you also notice there's absolutely nothing about our brand new distribution business that put us in the top 10 distributors in the U.S., albeit briefly, and the record-setting concert film from Taylor Swift, nothing about retail popcorn, a new branded credit card program, any new revenue increase captured from merchandise sales, but fine, whatever. Leave it out if you must. What I'm hearing is we are stable. We will suffer in the first half due to the strikes, as according to Moody's. We should improve as we move into the second half of the year. We should expect Adam to continue to pummel the stock with poorly timed dilution announcements, and because he insists on only selling at historic lows, we have a front row seat while he transforms the company into a zombie company. But that's why this channel focuses on black or white swans. To be perfectly honest, I don't think it would matter if AMC cured cancer. The bottom line is we are never going to get rid of the predatory short hedge funds until a swan event occurs that affects their leverage chain. Okay? Some sudden event that will turn the prime brokers against their best customers, people like Kenny Griffin. Now, I want you to know, after all the things we just covered from Moody's, this is how Reuters decided to report on it this morning. Half of Q4 U.S. corporate defaults are repeat offenders. Moody's by Matt Tracy. From the article, other defaults in the fourth quarter include AMC Entertainment, Equinox Holdings, and Rite Aid Corp., according to the report. Now, did we have any deratings on our debts? No. We exchanged stock for debt, and Moody's deemed that that's a default somehow. But the reporter goes a step further to put us under a headline that implies like we're repeat offenders or defaulters, if you will. So let's review this article together. So here we go. 7 a.m. this morning, half of Q4 U.S. corporate defaults are repeat offenders per Moody's by Matt Tracy. First, I wanted to research the author, Matt Tracy. On LinkedIn, he appears as a credit correspondent for the past year and 7 months. At Muckrack, I can see the article in question, and he's written for MSN US, MSN Canada, Reuters, and he's listed as the editor-in-chief of the Gay City News. I can't tell if this is all the same guy because his LinkedIn doesn't have his picture, and his picture isn't featured at Reuters either. All right, now guys, I'm going to review this article with you and try to find one reason why AMC should be in it at all. U.S. companies defaulted on over $19 billion of debt in the fourth quarter of 2023, half of which were repeat defaulters, according to a report by ratings agency Moody's Investors Service. So this author is basically including us on all the companies that defaulted multiple times. That's the headline that we're under here, okay? The 20 fourth quarter defaults contributed to a U.S. corporate default rate of 5.6% in 2023, its highest since the pandemic downturn in 2020, according to the Wednesday report. Now, guys, we had the best third quarter in our entire history, right? And the fourth quarter, we introduced our new distribution business, right? Beyonce and Taylor Swift. So I don't know if we really belong in this article, to be honest. We swapped stock for debt. We really didn't, we don't have any bonds rated D, which means default. Companies defaulted on more than $91 billion in debt last year, tripling from $38 billion in 2022. Half of the fourth quarter defaults were repeat offenders, the majority of which previously completed a distressed exchange. All right, that they're trying to put us under this too. A distressed exchange. We had $700 million in the bank when we did this, followed by an out-of-court restructuring. Also, really doesn't apply to us. In addition, roughly two-thirds of the fourth quarter defaulters were owned by private equity firms. Again, not us. Other defaults in the fourth quarter include AMC Entertainment, Equinox Holdings, and Rite Aid Corp. All right, I think I've read enough. Listen, if you're going to throw us in this article under this headline, at least they could distinguish some of the things we achieved in the third and fourth quarter of last year. My point here is Moody's had some positive items Matt didn't mention. AMC has achieved new revenue streams Moody's failed to mention. Reuters has no business including AMC under this headline. And again, I feel the timing is suspicious. With the Fed meeting yesterday and the stock rallying 5%, out of the gate, but as this news circulated and the market sold off, they managed to close AMC down. I really believe this author was told to include AMC in this article. Are you still wondering why Uncle Frank is obsessed with Swans? Hey, I want to thank you for watching, and please remember to hit the like button after this slide if you enjoyed the presentation. Subscribe to the channel and set the alert so you're notified when I have new information to share. See you at the bell.